In this learning objective, we describe how a managed fund, which is also known as mutual funds, operate and analyse some evidence on the relative performance of the active versus passive managed funds. So a managed fund is a professionally managed investment vehicle that pools money that's collected from several different investors, and they then go and invest that pooled capital. When investing the pooled capital, it's invested using a predetermined investment mandate. This mandate is the rules that govern the investment strategy, and the professional fund managers who are responsible for investing will then go about investing the collective pools of assets across various asset classes such as equity, fixed income or cash, according to the mandate of the fund. So, from the perspective of an individual retail investor, the idea of a managed fund can be significantly beneficial as it enables them to gain exposure to various asset classes that would traditionally only be available to institutional investors, and also to gain additional diversification across assets other than the diversification that might be possible if they had only directly invested their own money. So we know that most managed funds adopt a unit trust structure. So what this means is that when you invest your money, it's moved into the fund and units are created and issued to you in return for the money that you've invested. The fund continues to issue new units to new and existing investors as long as it's open-ended in structure, whereas a closed-end fund, as we saw in a previous video, will only have an initial public offering where they'll initially issue units, and they won't issue or redeem any subsequent units from that point forward. We call the value of each unit the unit price, and the investor is entitled to a pro rata proportion of the residual cash flows of the fund according to the number of units they hold. So let's say a particular fund has 1,000 units on issue and you own 100 of those units, you're entitled to 10% of all the profits generated by that fund. The unit price itself is generally a reflection of the value of the firm, although if it's a listed unit, there can be some market forces that also affect the price. And when we talk about the value of the fund, we talk about the net asset value. So the net asset value is the market value of the assets that comprise that fund. Net asset value is calculated on a daily basis, and where redemption is possible, redemption happens at that net asset value, usually at the end of every day. Now, when managed funds invest money, they earn income in the form of dividends, interest, realised capital gains, and all this money comes together and is made available to the unit holders. The fund manager is actually obliged by law to pay out this income to investors in the form of various distributions, although the frequency of distribution differs. It can be monthly, quarterly, semi-annually, or annually, and the investor themselves has the choice to receive the distribution as either cash or to reinvest it back within the fund. Now, when the fund goes about investing with respect to their mandate, there are two different ways that they can go and invest. And that means that there's two different types of managed funds. There are index funds and there are actively managed funds. So an index fund will be passive in that the underlying portfolio will be constructed such that it follows some particular benchmark, whereas actively managed funds seek to take advantage of the expertise of the professional fund manager using security selection and market timing in order to try to outperform the market. So starting with index funds, the idea of an index fund is to achieve the maximum possible diversification with low transaction costs. So given there's no active management, we're able to reduce the fees associated with trading, and it gives the investor the opportunity to invest in some representative basket of stocks. So the most common form of index fund will be a market index fund, which tracks the market index, and this is a way that investors can earn the return that's equivalent to the return on the market as a whole. So the performance in an index fund is determined basically purely by the asset class, because these funds don't attempt to generate alpha, so the return is not due to the performance of the portfolio manager per se. They should just be directly linked to the underlying assets. In contrast, with an active fund, you're taking a bet with a team of professional managers and their ability to generate high returns. So while the return is in some way still linked to the performance of the underlying asset classes, there should be some alpha, which is either going to be positive or negative, based on whether the active investment was able to either over or underperform. Now, obviously, what we know is that when you have an active fund, there's going to be significantly higher transaction costs, and there's multiple tiers to these costs. Those tiers are the transaction costs that are implicit in that when the manager buys or sells, this decreases the total value of the overall portfolio. But also you have to pay an explicit cost, which is a management fee, which is to compensate the professional fund manager for their time, their administrative expenses and so forth. And this can often be in the ballpark of 1% per annum. So, given there are these two types of funds, an important final question is which is better. And what we know is that the evidence shows that passive funds actually tend to outperform active funds. And there's a reason for this. The reason is that markets are relatively efficient, and they're sufficiently efficient such that an active fund finds it difficult to earn an alpha that is greater than the fees that they charge. So basically we find that before transaction costs and fees, active funds are able to generate a relatively small positive alpha, but because the magnitude of that alpha is smaller than the costs incurred by the investors, the net result is a decrease in wealth or a negative performance. So most studies would suggest that passive funds outperform active